Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing a significant warning from the Bank of Canada. Deputy Governor Carolyn Rogers recently addressed finance professionals at the Economic Club of Canada, sharing her concerns about the potential pitfalls of tinkering with the mortgage market. Her remarks are particularly timely as we navigate a complex economic landscape where mortgage affordability and financial stability are key issues. Rogers emphasized that while politicians often promote cheap credit and extended amortizations as solutions to housing affordability, these measures can actually erode affordability in the long run. She pointed out that there's no such thing as a free lunch when it comes to mortgage policies. Altering these policies might offer short-term relief, but could amplify long-term risks to households and the broader economy. One of the crucial points she made was about the nature of Canadian mortgage debt, which is largely state-assisted and securitized. This setup, while designed to prevent a large volume of junk loans, means that any losses can significantly impact market liquidity and financial stability. Given that mortgage insurance in Canada is backed by the federal government, large losses could have fiscal implications, a risk the Bank of Canada is keenly aware of, even if it considers it a tail risk. Unlikely in the short term, but possible in the long term. Rogers also reiterated a point made by her predecessor about the misunderstood role of credit in affordability. Over the past few decades, lower interest rates have not necessarily improved affordability. Instead, they facilitated higher home prices as buyers could absorb price hikes more easily. This has shifted the perception of affordability, but not in the way that benefits buyers in the long run. Furthermore, Rogers highlighted the delicate balance between supply and demand in determining house prices. While most people need to borrow to buy a house, the cost and availability of housing credit are influenced by central bank policy rates and government regulations. Recent efforts by the Bank of Canada to tighten credit availability through rate hikes have had limited success in curbing home prices due to overriding government policies. A specific example Rogers provided was the extension of amortization periods. While extending an amortization from 25 to 30 years can reduce monthly payments by about $200, it ultimately results in an extra $50,000 in interest over the life of the mortgage. This is akin to losing a year of income after taxes for the average worker, a cost that many may not fully appreciate. In conclusion, Rogers cautioned against relying too heavily on short-term measures that might reduce the immediate cost of financing but could have detrimental long-term impacts on the financial health of households, the mortgage market, and the economy. She stressed the importance of achieving a better balance between supply and demand to genuinely improve housing affordability. This approach requires time and careful policy consideration. In today's segment, we're diving into a potentially fierce competition brewing among Canadian banks, as highlighted by Royal Bank of Canada analysts. The analysts are predicting a mortgage war on the horizon, spurred by declining interest rates and a significant number of mortgages set to renew in the next couple of years. With over half of all mortgages with Canadian banks due for renewal, consumers are expected to be highly motivated to shop around for the best rates available. Following a period marked by significant inflation, the landscape is shifting. As interest rates decline, homeowners who originally took out mortgages during the peak of low rates now face the task of refinancing. According to Royal Bank of Canada analyst Darko Mihelic, a mere 50 basis point reduction in renewal rates could result in annual savings of about $1,000 for these homeowners. This potential for savings is likely to drive consumers to explore their options aggressively. The Bank of Canada's recent series of interest rate cuts plays a central role in this shift. After a prolonged period of high rates aimed at curbing inflation, the focus is now moving towards intense competition for mortgage renewals. These rate cuts are expected to shift the narrative from mortgage payment shocks to a competitive environment where banks vie for customer loyalty. Approximately 55% of all mortgages with Canadian banks are expected to be renewed within the next 2 fiscal years, with 85% coming up for renewal in the next 3 years. This creates a ripe environment for competition. Toronto-Dominion Bank, for instance, may find itself particularly motivated to compete aggressively, especially after facing restrictions on its growth in the United States due to regulatory penalties. In this competitive setting, all Canadian banks view mortgages as a cornerstone product. With low loan growth across various categories, the opportunity to capture market share from competitors is significant. Mihalik points out that banks like Bank of Montreal, Bank of Nova Scotia, and Canadian Imperial Bank of Commerce could be at risk of facing pressure on their mortgage spreads and potentially losing customers if they do not engage in the competition effectively. Moreover, the potential mortgage war could lead to lower margins and decreased net interest income for banks as they strive to maintain or grow their market share. The delay in developing open banking systems in Canada could further intensify this competition, as banks may look to offer lower rates on longer-term mortgages to lock in customers for extended periods. In summary, Royal Bank of Canada analysts anticipate waves of competition and strategic maneuvers as banks navigate this evolving landscape. As consumers look to benefit from lower rates, the dynamics of the mortgage market are set to change, potentially leading to a mortgage war that could reshape the competitive landscape among Canadian banks. Today, we're turning our attention to MCAN Mortgage Corporation, which recently reported a significant boost in its third-quarter earnings for 2024. This increase was largely driven by favorable market conditions and robust investment returns. MCAN Mortgage, also known as MCAN Financial Group, saw its net income rise to $26.9 million, or 70 cents per share, compared to $18.5 million, or 53 cents per share, in the same quarter last year. CEO Don Coulter expressed satisfaction with the company's performance, noting that total assets had surpassed $5.2 billion and net income had exceeded the figures from last year. Coulter attributed this success to the company leveraging various strategies to capitalize on the lower interest rate environment. Additionally, MCAN successfully raised additional capital through its at-the-market program to support its growth initiatives. MCAN's total assets have risen by 10% year-to-date, reaching $5.21 billion by the end of September. This growth was primarily fueled by an increase in securitized mortgages and stronger returns from MCAN's real estate investment trust investments, which saw unrealized fair value gains. Another significant contributor to MCAN's financial performance was its investment in MCAP, which brought in $6.7 million in equity income for the quarter, marking a 55% increase over the previous year. The favorable interest rate environment also played a role in boosting MCAN's mortgage origination volumes. Uninsured residential mortgages increased by 14% to $1.11 billion year-to-date, with $311 million in originations, reflecting a 9% rise from 2023. Meanwhile, insured residential mortgage originations reached $528 million, representing a 41% increase, and securitized mortgage holdings climbed by 19% to $2.29 billion. Despite a decline in commercial and construction mortgage originations, which was partly due to construction delays and permitting issues, MCAN's overall portfolio stability remains strong. The trend of borrowers opting to renew their existing loans has contributed to MCAN's sustained renewal rate, with $350 million in uninsured mortgage renewals so far this year. While there was a slight uptick in mortgage arrears, MCAN's credit quality remains solid. Most arrears were resolved within 30 days, and the company's uninsured residential portfolio maintained an average loan-to-value ratio of 63.5%. Coulter emphasized that, in the current environment, MCAN continues to see strong origination and renewal volumes across its loan book, coupled with good credit quality. Looking forward, Coulter highlighted MCAN's focus on strategic growth and positioning within the Canadian mortgage market. The company declared a fourth-quarter cash dividend of 39 cents per share, payable in early January 2025, signaling confidence in its ongoing financial health and commitment to shareholder value. Today, we're diving into some exciting news from Pineapple Financial Group, a growing player in the Canadian mortgage industry. Pineapple has recently made strategic moves by acquiring Lux Lending and Mortgage Magic, signaling its ambition to expand its footprint and enhance its service offerings. Pineapple's acquisition of Lux Lending, a boutique mortgage brokerage known for its high-end clientele and personalized service, is a bold step aimed at capturing a larger share of the luxury market segment. Lux Lending's reputation for bespoke mortgage solutions aligns well with Pineapple's vision of providing tailored financial services to meet the unique needs of its clients. In addition to Lux Lending, Pineapple has also brought Mortgage Magic into its fold. Mortgage Magic is a technology-driven company that offers innovative solutions to streamline the mortgage process, making it more efficient and user-friendly. This acquisition is expected to enhance Pineapple's technological capabilities, allowing it to offer a seamless digital experience to its customers. Pineapple's CEO, Shubha Dasgupta, expressed his enthusiasm about these acquisitions, stating that they are part of the company's broader strategy to drive significant revenue growth and strengthen its position in the competitive mortgage market. Dasgupta highlighted that the integration of Lux Lending and Mortgage Magic will not only expand Pineapple's service offerings, but also enable the company to reach a wider audience. By incorporating Lux Lending's expertise in servicing high-net-worth individuals and Mortgage Magic's cutting-edge technology, Pineapple aims to offer a comprehensive suite of mortgage solutions that cater to a diverse range of clients. This strategic move underscores Pineapple's commitment to innovation and customer-centric service delivery. Furthermore, these acquisitions come at a time when the Canadian mortgage industry is experiencing dynamic changes, with evolving consumer expectations and technological advancements reshaping the landscape. Pineapple's proactive approach to embracing these changes positions it well to capitalize on growth opportunities and deliver exceptional value to its clients. Looking ahead, Pineapple is optimistic about its growth trajectory and is focused on leveraging the synergies from these acquisitions to enhance its competitive edge. The company is committed to maintaining its momentum and continues to explore additional opportunities that align with its strategic objectives. Today, we're concluding our episode with some heartening news for the Toronto housing scene, particularly for those in need of affordable housing. The federal government has announced a significant initiative to transform the former Bond Hotel located at 65 Dundas Street East into 280 new affordable homes. This project is aimed at providing permanent affordable housing for vulnerable populations, including Indigenous people, New Canadians, women, and individuals experiencing homelessness or having diverse physical and mental needs. This transformation is part of a larger effort supported by substantial funding from both federal and city levels. The initiative is backed by over $123 million from the federal government through the Rapid Housing Initiative, along with an additional $9.5 million from the City of Toronto. The project is a testament to the collaborative efforts between different levels of government and organizations like Dixon Hall, which will operate the building. The building will not only offer a roof over the heads of its residents, but also provide essential support services tailored to meet the specific needs of its occupants. At least 15% of the units will include accessibility features such as roll-in showers, barrier-free paths, and support bars, ensuring that the homes are inclusive and accommodating. The first phase of construction was completed in the spring of 2024, allowing 92 individuals to move into their new homes. The second phase is currently underway and is expected to be completed by 2025. This development is a part of the broader national housing strategy, which aims to address the housing crisis by creating long-term solutions for those in greatest need. It's important to acknowledge the significance of this project as a beacon of hope and transformation. The former Bond Hotel, once a temporary shelter during the pandemic, is now being revitalized into a permanent housing solution. This not only addresses the immediate needs of housing, but also contributes to the renewal of the community, offering a stable environment for residents to rebuild their lives. As we wrap up today's episode, it's clear that initiatives like these highlight the potential for meaningful change when governments, organizations, and communities come together. This project is a step forward in ensuring that every Canadian has access to a safe and affordable place to call home, embodying the core principles of the Rapid Housing Initiative. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit Real Approved's KA to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.